So our next presenter is Shimon Kogan. He's Associate Professor of Finance with positions at IDC Herzliya, and at Wharton. He was on the faculty of MIT, Carnegie Mellon, UT Austin, where I just barely missed Shimon, and Duke. One focus of his research is on how information is processed in financial markets. His research often adopts interdisciplinary methods ranging from textual analysis to laboratory experiments to machine learning algorithms. His articles are published in the very best finance and economics journals like the Journal of Finance, the American Economic Review, and we're extremely fortunate to have him here with us today to present his work on how to distinguish facts from opinions in corporate disclosures. Shimon, thanks for sharing your screen, and it's all yours.
Thank you. And now that I figured out how to unmute myself, I can say that we are both Vitaly and I are absolutely delighted and honored to be invited to be part of this conference. Let me just sort of start by sort of setting the stage for what the paper is about. And in some ways, it's kind of the next step in terms of contributing to the work that many of you guys have done, in that, you know, we know by now that that information in earning calls is useful, like it has sort of some value relevant information, but we don't quite understand what that is, and so we're hoping to dig a little deeper into that, specifically along the dimensions of objectivity and subjectivity, or what I'm going to call that as facts and opinions, and I'll say more about that. So let me start with a quote by someone who by now is fairly famous. That's John Foley, co-founder and CEO of Peloton. Recently in the 2022 Q2 earnings calls, he said, "I'd like to start by stating how much I love Peloton. We've done a great job at delivering on that vision, and our large and loyal member community is a proof of that. But we also acknowledge that we have made some missteps along the way, which maybe is a bit of an understatement given that the stock price went from about 90 to 25. So maybe it's apropos. But so the bigger question is, why is he saying all of that, right? I mean, this seems like very much like a whole bunch of sort of cheap talk, right? There are very few facts in those statements per se. So the question that we're asking in the paper is we were really trying to quantify the use of what we're going to think of as cheap talk. So for context, the idea of cheap talk has been around in economics for probably at least since the 40s. And it conveys the idea that the information that you convey is costless to transmit and receive. It's non-binding and unverifiable, right? And so the big question, and you know, a lot of the communication that we see arising naturally through language is in this form. And the challenge for game theorists has been that kind of babbling is always an equilibrium, right? So if there's someone communicating to someone else, right, in a sort of standard principle agent framework, then it's always an equilibrium for someone to say, well, given that I cannot verify and it's costless to just say whatever you want to say, I'm just going to ignore it. And so the standard is going to say whatever they want to say, right? So basically kind of completely destroying, unraveling kind of the fabric of textual communication. So there's been a lot of work trying to understand how such a cheap talk may convey information, and that's mostly done through theory work and experimental work. But we actually know, I think, fairly little from field evidence on the ability, right? So we know now kind of when cheap talk can work, right? Can actually successfully convey information, but that's mostly theoretically and through experiments. But you know very little about its ability to convey information in the field. And that's what we're going to try and do, right? So broadly speaking, and I'll get more into the details of what we do, is we want to identify subjective and objective sentences, okay? And just off the bat, they're both really prevalent in earning calls. And roughly what we're going to do is we're going to split earning calls into sentences that belong into these camps. And we're going to put that features of that language on the right-hand side and put things that we care about, such as firm performance on the left-hand side. So it could be things, simple things like, just counting the extent of use of these different forms of language, and it could be using features of that language. Okay, so again, here's just a simple example. I'll give you more examples, all taken from the same earning calls. Opinions would be things like, we've done a great job delivering on the vision, etc. And a fact would be, we added 161,000 net connected fitness subscribers in that quarter, etc. So let me preview at a very high level what we're doing and the result. So part of the contribution is through methodology that I think many of you will find quite intuitive and appealing, in that it basically kind of merges human intuition with machine learning. So we're going to start out by manually annotating a database, a stratified database of both objective and subjective statement according to sort of expert opinions. So it's like basically human annotation. And then we're going to apply a deep learning model, classification model, to understand what the language features help us identify or separate out sentences that belong into the two groups. And then once we have that, then of course we can run this and on all earning calls. So what do we find? Well, we find maybe surprisingly that facts are almost as prevalent as opinions. In fact, opinions, take almost half of all sentences in earning calls belong to this class of opinions, and it's very much related to the role of the speaker. Okay? We find that essentially both of them matter, right? So facts are more associated with firm fundamentals, while both of them are associated with firm returns. And I'll offer some interpretation about why that is the case. We also link it to two different sort of use cases that are proxy for response to information. One of which is investment disagreement. So we find that with proper controls, higher usage of opinions is associated with higher investor disagreement. We also apply this to this sort of analysis of when anomaly returns are accrued, and I'll talk more about that. But we basically find that, again, higher usage of opinions associated with more pronounced realization of anomaly returns. So let me start at the beginning. Okay, the methodology. I think it's actually quite intuitive and straightforward. So we start out by establishing a definition of for human of what a subjective and objective sentence is. Okay, and I'll walk you through some examples, and I'll talk about at a high level what that definition is, and then we operationalize this definition for the context of earning calls, because we have to deal with a whole bunch of sort of cases, so to speak, that may arise in this context, and then we hand it off to experts, so just humans that are shown sentences. I have to classify them as being objective and subjective, and each sentence is being, of course, classified by more than one person. So that gives us sort of what we call a gold standard, right? And then we're going to estimate a deep learning classification model based on that annotated set. And once we're happy with its performance, we're just gonna sort of out a sample. We're gonna apply it to all earning calls and relate that to things that we care about, right, in finance. Okay, so let me give you some examples, right? So what do we mean by objective and subjective? So the key question, and it's not always easy, so it's not always a clear cut, and I'll give you examples where it's sort of muddier. But the key distinction in our opinion is whether people with the same information set as the speaker, so it's in our context, it's going to be typically the CFO, would very likely agree with the statement, okay, given that they possess the same information set. If the answer is yes, then that's an objective statement. If you may disagree with a statement, even though you have the same information, that is more likely to be a subjective statement. Okay, so simple examples for objective statements are this is all quotes from our data. Our earnings were 10 cents per share, or we opened a new store in New Jersey, or the costs are primarily related to the planned closure of our manufacturing facility. Okay. Examples for subjective statements would be our earning calls were great, because even if we see exactly the same data, I may think that this is great, and you guys may think that it's not so great, right? The analysis has shown that the brand has been distorted to bottoms, right? Well, what does that exactly mean? Last example that I have here, we talked about the immense opportunities we see in the solar space, right? So opportunities, sure. What does opportunities really mean, right? Like what does immense opportunity really mean? Okay, so those are, I think, fairly easy examples. Of course, life is not always as nice and easy, and we run into more ambiguous cases where part of the sentence is objective, the other parts are subjective. And basically, the way we instruct, so we write down the instructions for the the ones that are tagging the sentences, is basically use the judgment to decide what is the most meaningful part of the sentence is, right? Whether it's related to the objective and or the subjective part. And here I have examples for both. More than happy to take questions about this if there are any. I know that's like off protocol, Paul, but I just want to make sure that we understand the basic sort of underpinning of the paper, because otherwise the rest is not gonna make any sense.
It's all good.
Okay, so I'll take the. It's an open invite. Okay, so if you guys want to interject and ask clarifying questions, by all means. So what do we do with that, right? So we have about 3,600 sentences, and hopefully we're going to get some grant money and we'll be able to tag more sentences. But of course, that's sort of an expensive process. And those are all taken from earning call transcripts from 2012, 2019. We have about 60,000 firm quote observations of covering about 4,000 unique firms. And what we're doing is, with this set of sentences, we're going to train an off-the-shelf convolutional neural net model, completely off-the-shelf package, and then basically test its classification power by randomly selecting 200 objective, 200 subjective, and 100 irrelevant sentences. And F1 score is about 75%. So we're doing pretty well. Okay. So first headline result may be surprising, maybe not. I don't know. It surprises always about priors, right? But we find that there's almost that sort of close to equal use of facts and opinions in earning calls, right? So about 50% of all sentences in our data set, in our sample, are classified as opinions. 36 are classified as facts, and 14% are irrelevant. I didn't talk about irrelevant, but that's another class. That's another tag for sentences, right? So those are mostly procedural statements, right? And there are quite a few of them during earning calls, right? Like, well, next will come this and this, and she will talk about that and that, right? That's not a fact or opinion, just kind of procedural statement. Okay, and you would think that most objective or more factual statements are basically restatement of numbers, but that's not exactly the case. So kind of close to half of them do not contain any numbers. And this is not quite face validity, and we can spend a lot of time talking about why this is suggestive, but not very conclusive results. But this is just an image showing the fact that the terms picked up, right? The bigrams picked up by the classification model is separating out objective and subjective statements. They separate out in a fairly intuitive way, right? So on the objective side, you see millions and like sort of millions and billions, etc. And subjective, you see terms like strategic and progress and opportunities, right? So kind of along fairly intuitive lines. Okay, so some more just summary statistics, but I think they're interesting summary statistics. So the use of subjective and objective language seems to be fairly constant over time. Again, about 50% of sentences are objective, about close to 40% are objective, and the rest are irrelevant. We also see, we would interpret that as kind of related to maybe firm complexity, but companies in either more complex industries like non-durables relative to more standard or more simple industries like utilities tend to make more use of subjective sentences, and likewise large and growth companies tend to make more use of subjective statements. Okay. The other thing interesting, again, just summary statistics really, is that objective language is more prevalent. So, earning calls are kind of broken into two parts, like the presentation part and the Q&A. So we find that during the opening statements, there's more, relatively speaking, there's more use of objective language, and then there's sort of shift to subjective language. So we're showing that here by role, by CEO and CFO. And the other result that you can see in this two-way split is that overall CEOs make more use of subjective statements. Now, this is a whole other direction that we just sort of started exploring. But I'll stop that path here. We wanted to ask whether the use of that language is a firm or manager attribute, right? So what we've done is we've exploited a relatively small set of executive changes, right? And we're basically asking whether the use of subjective language a quarter after you've moved to a different company, how does that relate to what we observed for the same person in a different company in the past versus the use of language for that company in the past, right? So basically what we find is that for CEOs, it's mostly about their own personal style, right? The company doesn't really matter, right? They carry their style, right? And so if they tend to use more subjective language, they will continue doing that in the next company. And for CFOs, it's sort of a mixture of both. Both the attributes of the company and their own sort of personal style, I guess. Okay, so now I want to jump and Paul, give me a heads up when I'm about when I have a couple of minutes left, so I can cover the main results, if you don't mind.
Yeah, you've got about 7 to 10 minutes.
Okay, so I'm good on time. Okay. Perfect. So let's jump into kind of the main analysis. And what we're doing here is we're trying, and it's a difficult question, we're trying to quantify the sort of the relative, so to speak, ability of objective and subjective statements to capture value relevant information, right? So how do we do that? Well, what we're going to do is we're basically going to run a fairly standard machine learning models where we're going to put different things on the left-hand side. So what are the things that we're going to put on the left-hand side? Well, the current change in net income, right? So you're reporting in a certain quarter, like what is the change in net income of that quarter relative to same quarter last year? And we're going to do the same thing for future net income performance and for earning call for event window returns, right? So those are going to be the three regressions. And we're going to run this with using just objective statements and just subjective statements, right? Just language in those separate sets of words, right? So we're going to just a bag of words approach, right? So now think about this. What we're going to do is basically going to run, and we're going to do it on a rolling basis. So everything that I'm going to show you is out of sample predictions. But essentially what we're doing is we're estimating 6 separate models, right? So for each of those dependent variables, and separately for terms showing up in objective sentences and subjective sentences, right? So it's sort of like a 2-stage approach. So we're going to get a prediction, out of sample prediction, of say what a change in future net income will be, right? From the text, from the objective text in this earning call. And we're going to get a separate prediction, right, based on the model that we trained on previous data from the subjective words that showed up in this particular quarter earning calls. And we're going to put those predictions on the right-hand side, right? And basically the coefficients will be an indication of the relative magnitude of importance for those two parts. Make sense? And throughout, we're going to have a firm and quarter fixed effects. So, the first thing I'm going to show this in this form, which is I'm just going to focus on these coefficients, on basically these beta 1s and beta 2s, right? So if we look, right, at the change, at kind of like how important is language in objective and subjective statements for explaining current performance, that is the net income in this quarter relative to the same quarter last year, then it's clear that objective statements totally dominate. Okay, so that's the first result, right? And that may lead you to say, well, okay, well, that's kind of what we thought. We thought that the rest, all this subjective stuff, right, it's meaningless. Okay, just some fillers in the language, but not so fast, right? Because if we look at if we run the same exact analysis, but we look at the earning call return window, then we find that both of them are equally important, right? Well, how come? And I'm not suggesting that this is sort of by any means the only interpretation, but our interpretation is that opinions actually help us understand what current results mean for future performance, right? And why do I say that? Well, first of all, if we run the same analysis on future change in net income, then we find that both objective and subjective language matters almost equally, right? The other thing that we find, I didn't show it to you, but when we look at whether subjective statements, whether they are forward-looking or not, we find that actually very, very small fraction of them are forward-looking. So those subjective statements tend not to be statements about what will happen, right? So kind of putting those, kind of connecting these pieces of evidence together, we think again that subjective statements matter for returns because they help investors interpret how current performance will relate to future performance. Okay. And then in the time that I have left, I'll show you two other applications of the two other applications of this distinction in the context of things that they know that are associated with the arrival of information. Okay, so one of them is investor disagreement, right? So again, we have a lot of work linking investor disagreement with things with quantities that are generally kind of hard to rationalize with very standard neoclassical models like volume and volatility. So investor disagreement is sort of in last, I don't know, 15, 20 years has been an object of study, right? Now the question is like, what actually leads investors? The fact that we can kind of theoretically tie those two is interesting, but what leads investors to disagree? And our novel contribution to this literature is the composition of the disclosure that matters as well. So to show that what we're doing is we're building on the recent work by Nisser and Cookson that use direct disagreement measure from stock tweets. And what we're doing is we're just following their exact formulation. We're looking at abnormal log volume. And we're including their measure controls, etc. And our contribution is just adding the fraction of subjective statements in that particular earning call. And what we're finding is that companies, so again, controlling the lots of controls here, right, including fixed effects. So companies that make more use, or company quarters, right, that make more use of subjective statements, those instances are more associated with what we can interpret as higher disagreement, right, because we have higher abnormal volume. And when we control for Nisser and Cookson's own measure, which seems to be kind of almost like probably the most powerful, most direct measure, it does not is not subsumed by their measures, right? So it stays equal in size. So again, subjective statements or the use of subjective statements is associated with higher investor disagreement. The last application that I want to discuss in this very interesting paper by Joy and co-authors, looking at when anomaly returns are realized. And their intuition is something along the following lines. What they're saying is basically that when information comes out around earning calls, if anomalies are created from the fact that investors tend to be sort of have biased beliefs, right? And the release of information will make them less biased, right? And so the anomaly returns will be realized during those times. And in fact, they show that in their paper. That's what they're doing. And so what we're going to do is we're going to replicate effectively their work by looking at sort of a whole bunch of well-known characteristics. And our contribution to this will be to ask whether this accumulation of returns on earning announcements is associated with the use of language. And the short answer is, well, first of all, we can replicate closely to what they got, right? So basically, companies, right, that are associated with having higher score on the different characteristics, right, on long side, on earning announcement days, they generate large positive returns. Our contribution is to show that most of this, or visually in our context, all of it is realized for firms that make extensive use of subjective language. So let me wrap it up. What are we doing here? We're basically trying to take one step further in understanding what is it about the language, the text in earning calls that is value relevant, and we're doing it by annotating sentences, classifying them into subjective and objective, and training a model that allows us to scale that classification to the entire data set. And we're showing that what we would think of as cheap talk, and again, may be tempted to dismiss as being sort of just filler or value irrelevant, in fact, is relevant and is associated in various contexts with arrival of meaningful information. So let me stop here, and more than happy to take, Vitaly and I are more than happy to take questions.
Thank you so much. Yeah, we have at least 5 minutes for questions. Go ahead and call on people.
Sure. Megan?
Hello. This
Hi.
was so awesome. Thank you so much.
Thank you.
Question is, do you believe the subjective statements are a response or a trigger for disagreement? Because I thought that was really insightful. And then related to that, did you observe any patterns or correlations by industry under that?
Related to disagreement or overall?
Particularly related to the disagreement.
So I don't think that Vitaly, by the way, feel free to jump in, but I don't. We did. That's a good question. We didn't look at. I don't think we looked at industry in the context of disagreement. So whether it's, I don't have a way. I mean, it's a good question. Right now, we're finding a correlation between those two, right? Disentangling, so the cause and effect here would be a little tricky because you know how it is. Like pretty much everything is correlated, right? And so we're trying to use all these things that are correlated as controls. So that's the stuff that I skip, right? So look past various interval returns and volatility, etc. But it's a good question. Maybe we need to do more work trying to disentangle the two. Dwayne, good seeing you.
Hi, good to see you, Shimon. Really interesting presentation. I guess I had two questions.
Yeah.
One was, when you looked at the impact of the sort of subjective opinion language, does it differ in terms of the tone of that language? So if the opinion is we're doing great and things are wonderful versus we've had a problem, does that matter in terms of how it's interpreted? And I guess a related question would be, in terms of trying to relate I guess there was a sense of interpretation of what's currently driving the firm's earnings and how that might then extend to what's going to happen in the future. That's kind of how I sort of connected those two things. And so I guess that there's a question then, is the degree of persistence of earnings surprises or earnings, is that sort of related to, that's something that you could measure and then try to relate earnings persistence to the language that's being used?
So let me start with the second. It's a really good idea. We haven't looked at the persistence of earnings. We'll look at that. And related to tone or sentiment, right? We kind of started out with that, so we have a lot more to say about this, and it's kind of got pushed to the back of the paper. So the short answer is that I don't think that in the finance literature, right, there's a very good distinction between so basically sentiment shows up as whatever words correlate with returns, right? But that's not typically in NLP the way you define sentiment. And we actually find that making that distinction of making that separation into objective and subjective matters, right? So that's the short answer, right? And we have some results on that in the paper.
Right. So I guess what I'm asking is, so you have objective and subjective, and then within each category, there's
Correct.
positive and negative.
Correct. Exactly. Exactly. Exactly.
And I guess the question is whether they're equally credible, the positive subjective statements.
So the
in
first thing is that they're different. So first of all, they're different, right? So that matters, and whether they're different. I don't remember off the top of my head, Vitaly. If you recall, then unmute yourself and chime in.
Yeah. Hi, Dwayne. Hi, everyone. Yes, the negative matters a little bit more, and the overall for both objective and subjective. But there is no large difference in how sentiment interacts with objectivity or subjectivity, if that makes sense.
Cool. Diego, good seeing you as well.
Great to see you, Shimon. I have a couple of comments that I'll send you via email, but the question that I have actually has to do with the Q&A section, which I think is the more interesting piece of these calls. And it seemed from the presentation, I guess this can partly a clarifying question, that you're ignoring the questions and you're just focusing on the answers by the CEO, CFO, whoever is in the call. And I guess my question would be, I mean, it seems like an interesting piece to look at. Is the question being asked a question that has an objective answer, or is it a subjective question? And what kind of answers are they given as a function of what we're asked? You can imagine somebody asking a factual question and the CEO going around the bush and not answering, right? And I think you guys could actually measure that.
It's a good. It's not obvious to me how we would do that. Like you want to classify. You want to basically classify questions into questions that can be answered with objective statements and the ones that cannot, right? Something like that.
Something like that, yeah.
So in practice, like the vast majority, like over 90% of questions you can see can be answered either way. You know, it's very hard to develop a coherent sort of classification scheme that would account for that. You know, we tried, but we found that
so you're
makes more sense.
The questions away in the.
Yeah, we throw the questions away. Yeah, we don't tag the questions.
Essentially, all questions are, you know, irrelevant. Subjectivity, objectivity is not applicable.
Yeah.
Great. Thank you so much, Shimon.
Thank you.